It's 9:46, and I wanted to show you and make an update as to the position on Boeing and where it stands now. Being 16 minutes into the market, things do ramp up during that time. The first probably half hour to at least 15 minutes, there's a lot of volatility. And then also show you this workhorse position that I have on. So in the previous video on the Boeing poor man's covered call, I was up like 575 and down 675 on the long versus the short, and now as you can see, both are in the negative. When you're starting to do poor man's covered calls and covered call writing, don't be afraid of what you see in the negative right now. And remember, go back to the basics of why we set this up. We buy a longer contract. I like to do 2 years out at least. That gives me plenty of time to make up for my money that I've invested to sell the contracts against it. The goal and the initiative here is to get, or to hope that Boeing breaks the 205 and I completely get the premium, get out from the position to buy over again on another dip. Or I just keep selling covered calls 35 days to 45 days out against this long to be able to pay this thing off. So the quicker that I pay this thing off, this long then becomes free. And then I can keep a hold of it. I can do whatever I want with it. I can sell another covered call, let it go, or I can just exercise it to be assigned 100 shares and then start selling covered calls against the hard asset of the shares, or I can just keep selling contracts against it. It's whatever you want to do. If Boeing or that position or that stock pays out a dividend, it's probably more wise to exercise that, grab the shares, and get that dividend while you're writing contracts against it. That's what I like to do. I'm not saying do that. I'm just saying that's one of my go-tos and probably what I would do. So that's the update on Boeing and why you see these negatives. They're really not a negative. It's going to be $1,100 for sure if I ride this out all the way to the end, which is the 52 more days. If I get to buy this back cheaper, I probably will do so. I usually try to get 50% of my profit target, which is around $600 to $700. And then I'll just buy that back and then do it all over again. And then on this put, if you're not selling puts on stocks that you want to own, then you're just cutting yourself short on any extra money. And we sell puts to lower our break even or lower our strike price of what we want to actually buy that stock at. I could just buy Workhorse right now for $16.83. We see it right here. That's what the Workhorse group is now currently trading at. However, I sold a put at 7.5. I sold 2 of them. What I'm doing is I'm taking in premium. As we can see, I sold these for 70 cents a piece. That gives me a $140 profit if it does not drop down to 7.5. If it does drop down to 7.5, well, cool. I just picked up the stock cheaper, over a 50% discount than what it's currently trading at. Now, is that really a good sign, though? If it drops over 50% in the next 17 days, we might have a problem. However, most stocks, you have to just simply look at the fundamentals, the financials, and everything that I showed on the course over on the investingwithchris.com website. But anyways, that's why I always resort to poor man's covered calls, covered call writing, and put selling. Because those stocks that I'm already interested in on the put side, you get to make literally free, I don't want to say free cash. There is the risk of it getting assigned to you if it drops down to 7.5. But just keep that in mind. So that's another helpful video that I wanted to put out for you guys. The market's going pretty good. We can look at our market watch. We see a lot of greens. Microsoft, Facebook, Apple's kind of in the red. Google, but our Amazons, Walmart, P&G, Procter & Gamble, JP Morgan and Chase, Bank of America. So the financial institutions, the tech world is doing pretty good today. The Nvidia, Intel Corp, Texas Instruments. So yeah, as we can see, the technology and financial sectors are doing actually pretty good today. So just keep that in mind. PayPal, it's up 1.25%. I would start looking at premiums. Here's one thing that you can do before we go, is look at PayPal. Can't get the ticker up for some reason. I'll just type it in. It actually finds it. There it is, PYPL. And if I want to just quickly look, premiums are actually doing pretty good. We see 700, 500, same on the short side. So if we was looking to get into PayPal long term, we'd do about 30 to 35 days out. Look at the premium. Look at your deltas. Remember, I taught this too. Look at your delta. This is the probability that you could probably get into the stock with or sell this premium and not get assigned. Delta correlates very, very, very close to your probability of success or probability of being out of the money. So I could sell this for $98 and risk $1,300. I could push this all the way up. Always like to remind you guys to, when you're selling, make sure you're trying to sell it for the highest that it's currently trading at. So I'm risking $13,000, 100 shares at 13, the 135 minus the premium that I take in. So it cuts down. I take in that premium, it cuts down. I actually have to acquire that at $13.50 for. So let's do the math here. Let's do 125. See what our risk on investment would be. 125 divided by 13,375. Yeah, it gives us a 0.9% return. So it's really, really not even worth it. I'm not even going to look at that. I could, but to me, that's just not worth it. Some people like to say, "Oh, it's an extra $100," but if it does get assigned now, I've got $13,000 that I've got to tied up into one position. So to me, it's just not worth it. I could do a debit spread or a credit spread, and what this is, instead of taking control of an asset, taking control of the 100 shares, I would just do this. Sell at the higher strike price and buy back at the lower strike price. Gives me a 46 cent credit, $46 for a $450 risk. Now, since there's no asset to acquire, we're just selling one contract and then simultaneously buying back another. If this stock drops down below the 140 and the 135, then we lose out $454 and we don't make the $46. However, if it stays above, then now we've risked 10% or done a 10% risk on return. So it's literally, I'm putting up $450 at stake. I'm making $46. Gives me a 10% risk on return. So to me, that might be worth it. But it's just whatever your risk tolerance is. This is a good thing with options. You see up front what your income or what your profitability is and your statistical probability of success. I really don't like to just buy stocks that I have that I haven't looked at their financials and don't know what they're going to do. No one knows what a stock is truly going to do. We could say that their financials are strong today, but then the COVID crisis hits and then they plummet and now we're in the negative. If I'm literally trading risk on profit, then it becomes a little bit more financial, financial smarter to me to be able to do this. But this is why I teach stock options, is that we know ahead of time what our profitability can be and what our max loss is versus putting up $13,000 to lose big time. So keep that in mind too, guys. You can always resort to credit spreads on the put side. I always like to at least make 10 to 20% for sure. There has to be plenty of open interest and volume. Open interest is the current positions open, and the volume is currently the amount of trades that happen today. So as you can see on this time frame, the 31 days, there's been zero. So it's probably going to be hard to get into unless one of these open contracts are set to correlate with this same strategy or this same move. So if I sold this, 101 people out of 101 people would have to want to buy this. So if I'm the seller, there has to be a buyer. So the other thing that I can do, I can go down here and look at the poor man's covered call, see how many open interest at the 80 I like to at least make $80 for every dollar move up. And that if you don't know what I mean, reach out to me and I'll explain that one. But I also don't want to pay more for the contract in this poor man's covered call than the actual strike price itself. So 100 shares at the 110 would cost us 11,000. So right here, if I buy this for 7,000, it's cheaper than 11,000. So I'm hedging down to control an $11,000 position for only 7,000. So it's a little bit cheaper. So right here gives us the break even, or you can just add the 71.35 to the 110 times 100 gives us the 11,000, and now you can see that's our break even, the 181.35. I would go 31 days out and at least look at the premium above the 181.35 strike price. So if we invested $7,100 today, we look at 38 days, and we know our break even is 181. There's no 181, there's 182, so that would cover the width. Remember, the simultaneously buying or assignment at the 110 and then selling it at the 182.5 would cover the $7,000. It'd actually be a little bit more and cover that, and would get profit there, plus the 475 to 555 in profit. So if I move this all the way up, 515. So if we make $515 off of 7,100 bucks, it gives us a 7.2% return in 38 days. If the stock continues to go up. If it goes down, we're still making the $515, but now our long, we would just basically have to go a little bit lower in our strike price, adjust for our break even, and then go down to the 180, 177, and so on and so on. Another 30 days out. Here's another little hint for this video. We see that the current implied volatility is 41%. So these premiums are mid-range of what they normally trade at. Okay, so let's take a look at today's option statistics, and we see the current IV percentile is currently 33%. Its 52-week high is 95.9%. Its 52-week low is 20%. So we're in the 33% range. We correlate that with the current HV percentile, and we're not even halfway up. If the current historical volatility percentile is 50% or maybe 45% or higher, then the option premiums are more on the high side. So this PayPal can actually shoot up a little bit more, and these premiums could be a little bit better for us. So are we willing to get in this position quite yet? If I do not know that, if I want to say, okay, maybe the premiums can go up, maybe PayPal can be a little bit more volatile, I would go to my my chart on PayPal, and I would check to see what the chart is doing. And then I would correlate it, and this is where a lot of the options knowledge comes in hand, and why there's so much to understand about options, when to get in them, when to get out of them, and how to use your charts. You could do a Fibonacci retracement and kind of see where the 50% mark is, but we're in an uptrend. So what I've just done is, if PayPal somehow ends up going into a downtrend, or the trading pattern or the trading trend changes, we're looking at this 50% mark. If it drops below 50%, which is the 128.50, then now PayPal becomes a bear move, and we would get into that on the bear strategies. But right now, I think PayPal is holding strong. We would have to look over on its financials and see what exactly PayPal is doing. We see that the earnings has been pretty good. They're in a positive. Let me remove this. This one was lower than this quarter, and this quarter was higher. And then back here in 7/24 of 2019, almost the same time of what we're looking at right now, it was 86 cents. So we want to do we want to basically beat last year's quarter? If that is, then we're probably going to go positive. We definitely have to beat this previous quarter for 5.6. So actually, you know what? What is that doing? I just found something. So 129.56. And this goes back to a 2. So they're on. Interesting. So something I just realized is this earnings report came out on just last month, and now they're already going to have another one next month. So what is going on there? Why are they doing a monthly earnings report? Usually it's every 3 to 4 months, depending on their fiscal year and everything else involved, or what their reporting time frames are. But as we can see, this went from 7/24 to 10/23, so 3 months there. This should be, yeah, 3 months, 5 months. So they must have changed the reporting's time frame. So anyways, we would look at the RSI, see what the trend is doing, and see if maybe there's some kind of short-term retracement coming. This looks bearish, or no, actually it looks bullish. So we're still trading good here. So we could look at PayPal and determine, okay, in 38 days, but we know the earnings report is coming up. So we want to go a little bit less than that, and we could possibly do a 160. But remember, again, you're risking $180 for a $15,000 capital, or your capital is going to be tied up. So is that really worth it? That's what investing and using smart finance is all about, is really not getting into the assets themselves, but getting into their options for short-term profits rather than holding and waiting for them to go up to only crash once you get into them. And trust me, it's happened to me multiple times when I've bought the asset and to find out it actually crashes afterwards. So this looks like it's starting to even out. We have a higher low, another little bit higher low, but there's little small moves in the 4 hourly. We can look at the daily, and we can see that it's had higher lows each time. So is this on an uptrend? Most certainly, but how long? We don't know that. As always, that's it for this video. Drop any questions you have down in the comments section, and until then, I'll see you next time.